Introduce our first keynote speaker today, who will be joining us virtually, remotely. So Cornelia Holthausen, who is the Director General of Macroprudential Policy and Financial Stability at the European Central Bank, formerly Deputy Director General of Market Operations Area in European Central Bank. Also active participant of the academic community. So the title of Cornelia's presentation today will be the role of macroprudential policy in an evolving technological and climate finance landscape. So welcome, Cornelia. Thank you very much for joining us today, and the floor is yours.
Thank you very much, Olli and Jose Manuel. So good morning. Can you just confirm that you can see my slides and that you can hear me? I hear nothing to the contrary, so I hope this is the case. So good morning. I'm very grateful that you organized this in a hybrid format, even though I'm a fan of physical meetings, but for me it turned out well because I had some other commitments, and also I just recovered from COVID. So I hope that my voice will carry me through this talk today, because that was impacted a little bit, but I think it should be fine. So I think this looks like a great conference agenda, really very important issues that we are confronted with on the financial side. And in my talk today, let me think a little bit broader about a change that is impacting now the financial sector. So because the current geopolitical environment has exacerbated some of the challenges that are related to COVID that financial sector is already facing, and has exposed some vulnerabilities to the financial sector that need to adapt to this change. So I will actually and sorry, this box here, probably I have to move it somewhere. So I will in the presentation today start by giving a brief overview over what we think are some of the key themes that are shaping the financial stability outlook at the moment, and what macroprudential policy can do in this environment. And then I will focus more on the main topics for this workshop, in particular climate change, and then also the technological innovation. So let's start at looking what we think are some of the key financial stability issues at the very moment. So in a few weeks, we will publish our financial stability review. So keep an eye on it, out for it, in case you are interested in reading more. We think that there are three themes that are shaping the outlook. The first is the environment of low growth, high inflation, and tighter financial conditions that are starting to expose some vulnerabilities among corporates, households, and sovereigns. The second area is that even though we have already seen significant corrections this year, financial markets and non-banks remain vulnerable to negative surprises. And third, even though banks are benefiting from higher interest rates currently, their asset quality outlook has deteriorated. Some of this in more detail. So the growth and inflation outlook are key to the financial stability outlook at the moment. You see that there has been a continuous downward revision to growth forecasts, as you can see on the left, and at the same time, inflation expectations have continued to be revised up. And from a financial stability perspective, a key question is to what extent these developments will lead to corporate defaults or higher unemployment, because that will ultimately determine how large losses will be for banks and other financial institutions. As you can see on the right, unemployment is expected, so both by the ECB and also private sector estimates, to increase in the coming years somewhat, but not by much. And I think this environment should then support asset quality, hopefully, in non-financial sectors. But we cannot exclude that there could be a more adverse scenario, and we need to keep in mind that there are large differences across countries. So there are several factors that are driving financial vulnerabilities in the non-financial sectors. The high inflation and the erosion of real disposable income that comes with it, and the savings accumulated during the pandemic, together with the higher interest rates, they weaken households' debt servicing capacity. Looking at the left-hand side, Euro area property markets still saw quite some almost double-digit nominal price increases and sustained strong lending growth in the second quarter of this year. But you can also see that in the 2 years past, the residential property prices were not negatively impacted by the pandemic. And that was thanks to support measures, low inflation and low interest rates. But now we don't have those low inflation and low interest rates any longer. And the increased demand for residential property during the pandemic is fading off. And as a consequence, we might see a significant correction in the period ahead to be seen. Looking at the right-hand side, next to high inflation and energy prices, recession risks and tighter financial conditions also pose challenges for euro area firms. On aggregate, the profitability of the euro area corporate sector held up relatively well in the first half of the year, because firms were still able also to pass on higher input prices to customers. However, the weakening outlook put a dent in corporate earnings growth expectations. It actually turned negative in real terms just recently. And a more pronounced economic slowdown, together with a further tightening in financing conditions, might pose more acute challenges for firms. Let's turn to financial markets and non-banks. We have seen a very large corrections in asset valuations in 2022, as you see on the left. And these valuations still remain sensitive to worsening macro fundamentals and the uncertain path for monetary policy tightening. And while these corrections have been orderly, different assets have shown also a strong price co-movement, and that's a development that complicates diversification strategies and could also amplify losses. Increased market volatility, effects for margin demands, and lower liquidity in some market segments also increase the risk of disorderly episodes. Significant financial market repricing has translated into higher market volatility, in particular in interest rate markets, as you can see in the middle chart. And non-bank financial institutions are exposed to a further rise in bond yields and possible forced asset sales amid a low liquid asset holdings. While the cash holdings of investment funds have risen since early 2022, as you see on the right, funds' liquid asset holdings remain low, even though volatility has risen. And therefore, the risk that investment funds could, in an adverse scenario, amplify a market correction via pro-cyclical selling behavior remains high. And in addition, non-banks using interest rate derivatives, including insurance companies and pension funds, they are exposed to funding liquidity risk from unexpectedly large margin calls. And subsequent forced asset sales could again amplify adverse market developments and pose a risk to financial stability. Let me end my broader overview of the risk landscape with a slide that focuses on the banking sector. Rising interest rates that we currently see bolster euro area banks' short-term profitability outlook. So that's on the positive side. And indeed, euro area bank profitability remains solid in the first half of the year. Lower operating expenses also, there were reduced loan loss provisions and higher operating income thanks to the wider margins in this environment of rising interest rates. You see that on the left. And also bank analysts have revised upwards their forecast for return on equity for the banks. But these expectations are all based on an assumed benign evolution of future credit losses, and they are subject to downside risks. Despite the worsening of the macro outlook, euro area banks' asset quality did not yet show signs of broad-based deterioration. But as interest rates rise, it's possible that banks could face higher credit risks stemming from growing exposures to vulnerable non-financial sectors, and notably residential real estate markets that I alluded to earlier on. And banks' cost of risks that are defined as impairments on loans divided by loans have fallen to pre-pandemic lows, as you can see in the middle chart, but they could rise going forward, driven by both the need for higher loan loss provisions and the adverse denominator effect from likely lower loan volume growth. But with higher market funding costs, funding low-yielding asset profitability is also more challenging. Banks' bond funding costs rose markedly during this year, and this was again driven by expectations of monetary policy normalization, growing recession fears, and deepened geopolitical tensions. So it's a challenging environment for banks, but I think we can say so far so good. Now, the title of my presentation referred to macroprudential policy. So let me say a little bit how we see the current environment for macroprudential policy making. It has become more challenging. I think this is clear because the war has compounded existing vulnerabilities and also increased the likelihood of risk materialization. And on the one hand, this makes it more pressing to address identified vulnerabilities. But on the other hand, it also bears the risk that policy action results in an unintended tightening of credit conditions, and that, of course, we want to avoid. From a purely risk-based perspective, we at the ECB would still see a need for higher capital buffers to address cyclical and real estate vulnerabilities, at least in some countries. And this slide here shows our main cyclical risk indicator at the euro area aggregate level. And as you can see, it still stands at an elevated level, and this is driven mainly by credit and real estate related factors. But you also see that the indicator may already have peaked. But as I explained on the next slide, we think that even this late in the cycle, an increase in buffer rates could be beneficial. So how do we balance this need for higher buffers with the risk of pro-cyclical effects? Well, I think that not in all cases there's that much of a trade-off as one may think, and this is because the main role of capital buffers at the current stage should be on preserving capital and resilience that is already available in the banking sector. In other words, it's not about asking banks for more capital, but rather to ask them to maintain sufficient capital to be able to support the economy as needed over all phases in the cycle. And the fact that banks already have the capital that is needed also mitigates the risk of pro-cyclicality. In addition, all authorities always also have the possibility, of course, to release buffers if and when adverse developments materialize. So overall, we consider the risk of pro-cyclicality to be still muted at the current stage, but we of course also see challenges arising from economic headwinds, and therefore we think that communication and predictability of policy action are really key. So in sum, we believe there's still scope for targeted adjustments in buffer requirements in selected countries, and you can see here an overview of countries that have acted as of late. But let me not go into more detail here. The financial system is not only confronted with more immediate financial stability challenges that I've just explained, but it has been undergoing a transformation for many years now, where various internal and external factors have led to a need for banks, non-banks, and markets to adjust the way they operate. And among the factors listed on this slide, I will now focus on climate change and the innovation aspect, which are the themes of today's workshop. I will put most emphasis on the climate change topic. Yeah, so let me start with financial institutions' exposures to climate change. Together with the ESRB, the ECB has been working on this topic for several years now. And the framework that you see in this slide comes from a joint report that we published this summer. The development of a financial stability monitoring framework requires some vulnerability metrics. So on the top left side, you see that non-financial borrowers are exposed to climate-related factors such as greenhouse gas emissions or physical hazards. And in turn, financial institutions are exposed to non-financial entities, mainly through the credit instruments and also insurance liabilities. The risk dimension on the right-hand side, that can be quantified through the impact of climate-related factors on the incomes, profits, costs, or damages of non-financial borrowers, and on credit or valuation risks for financial institutions. The risk assessment for financial firms require detailed knowledge about the impact of climate-related factors on financial risks. And as you can see on the bottom, there's also a focus on the need to capture system-wide risks, notably those arising from interdependencies and spillovers. And indeed, the exposures and riskiness of individual institutions may be subject to interdependencies between climate-related factors, economic entities, and financial institutions. And these system-wide aspects give rise to the amplification and propagation of risk to financial stability. And taken together, these system-wide factors can give rise to clustered risk materialization and contagion. Now, let's look in more detail. As I mentioned, it's important to have a good understanding of financial institutions' exposures to climate risk. And I will now bombard you with a couple of slides that I hope illustrate this well, but I will not be able to go really into detail in all of these slides. So if we start with banks, around 2/3 of euro area banks' corporate credit exposures are directed towards high-emitting firms, as you see on the very left side, and that's in particular it's the red part of this bar. While firms' emissions have been decreasing, we saw that credit exposures of euro area banks to these high-emitting firms have, however, remained broadly stable in the last 4 years. And a metric that's commonly used to monitor climate-related transition risk is the average emission intensity of credit exposures, weighted by the exposure value, and that's also called the carbon footprint adjusted loans to total loans in the IMF climate dashboard. And this metric shows heterogeneous results across countries. The main contributions here come from mining and manufacturing, that's the yellow part, and electricity, the red part. And these sectors account for almost 60% of the total at euro area level in terms of exposures. And looking at the right side, of course, the information on the carbon emissions can be combined with the existing probability of default of these corporate borrowers. And this can be used to provide a credit risk adjusted metric of transition risk. And the resulting indicator is this PD, so probability of default weighted emissions to loan ratio that I show here on the right-hand chart. And looking at the results, so once adjusted for financial risk, you're using borrowers' PDs, the estimated transition risk has increased notably, I think, since 2012. And in particular, with significant increases in those sectors that face more underlying transition risks. And you see that some of these sectors on the other hand, make an almost negligible contribution to the emissions to loan ratio, but they play an important role when the financial risk component is considered. So I think bottom line is here, banks are facing increasing transition risks. Now, this slide provides some more information on banks' exposures, focusing on the physical risks aspect. So as you see in the left chart that around 30% of euro area banking system credit exposures to non-financial corporations are to firms that are subject to high or increasing risk due to at least one physical risk driver. So this is the yellow part at the very right. And looking at individual hazards, around 10% of loan exposures involve firms at high or increasing risk of flood, heat stress, or water stress. And taken together, around 80% of the loan exposures are to firms with at least some exposure to physical risks. Now, this may become increasingly relevant if emissions are not effectively reduced in the long run, and if firms and economies fail to adapt to climate change. Excuse me. As mentioned in the previous slide, the combination of the financial vulnerability with the climate-related vulnerability is also relevant here for physical risks. And we have again computed this PD-weighted physical risk score here shown in the middle. And you see that based on this ratio, up to 11% of loan exposures to up to firms with high physical and financial risks. And these loans are predominantly held by firms that are vulnerable to wildfire risk, followed by water stress and flood risks. But you also see that the results are really very heterogeneous across countries. So the key message for banks is that short-term costs of green transition are generally more than compensated by long-term benefits. So if policies for a green transition are not introduced, physical risks become increasingly and also in a non-linear way higher over time. And this is due to the irreversible nature of climate change. And this you see on the right. The impact from climate risks on average, that's the dashed lines, increases moderately until 2050, but we know that it's concentrated in some areas and sectors. And looking at the tail events, so for the banks that are most at risk, the impact can potentially be really very severe, with possible consequences then also for financial stability, and these are the solid lines. We have also done internal analysis that looks at common exposures. Shocks associated to common constitute a new source of previously correlations. And I don't want to go into detail into this complicated slide, but let me give you two key messages. So the default correlations increase more for high emitters than for low emitters, but perhaps unexpectedly, the impact of transition risk affects more the lower end of the distribute of default correlations than its upper tail. Meaning firms with historically low default correlations are impacted more by transition risks to our analysis. And if you think about it, that could have important risk implications because those are more likely to be off the radar for banks' risk management and monitors. But it's not only banks that are exposed to climate-related risks, it's a whole financial system that is exposed. And here in this slide, we look at the exposure towards transition risks beyond banks and consider also non-banks. Sorry, this window keeps moving. In particular, we look at insurance companies and pension funds, so that's on the left side these charts, and the investment fund IF sector. Now let me focus on investment funds here because they're better visible. We see that similar to what we saw for transition risks for banks, around 30% of euro area non-banks holdings of securities that are issued by NFCs with the known emission levels. So these are the parts of the bars that are not gray but are more colorful. They are currently issued by high emitting firms. And this is a share that has only decreased very slightly over the last 5 years, as you see by the green line in the left chart. In absolute terms, the amounts are quite significant as well, in the order of single-digit euro trillion. As we have done for banks on the right-hand side, we consider the exposure of non-banks to physical risk. Again, let me focus now on the investment fund sector on the right, on the far right, and we see that some of these non-banks are already quite highly or increasingly exposed to physical risks. This is usually concentrated in certain geographical areas. There are some factors why the risks are likely to be exacerbated and go beyond what we would think from this chart. And this is because some investors hold assets that are vulnerable to multiple hazards. And we should also bear in mind that if there is a physical event happening, there could be fire sale dynamics that amplify the impact of these physical hazards. And also, as we have seen in the first part of the presentation, the current low non-bank liquid asset holdings could amplify any adverse market dynamics. Now let us turn to markets. Non-banks and financial markets have a very important role to play in the transition towards a low-carbon economy. So the chart in this slide shows that the sustainable markets, so the ESG markets, continue to grow globally last year, mostly thanks to an increased volume of euro area ESG funds and green bonds. The slower growth during the first quarters of this year shows that maintaining the momentum requires decisive regulatory actions to strengthen capital markets. And the chart on the left shows assets under management of euro area ESG funds, while the chart on the right shows developments in green debt and credit. So overall, the growth has accelerated between 2018 and 21, in particular after the pandemic. And these developments also reflect the expected green investment through the EU Recovery Fund, so the next generation EU, and also because there was a sharp increase in the number of financial institutions that have made net zero commitments. But still, the sustainable markets only account for 10% of the euro area investment fund sector and 3% of outstanding bonds. Empirical evidence suggests that green finance supports green investment and the reduction of emissions, with some differences across firm types. Research suggested that a higher share of equity financing is associated with greater reductions in countries' carbon footprint, but still, debt is the primary source of external financing for NFCs in the EU, and it is also used to support the development and adoption of greener technologies. Let me skip this slide. Now, how about greenwashing? Companies claiming to be green, while this is not necessarily so clear, and one reason is that we don't have a commonly defined standard. Looking at the left-hand side, in the absence of an ESG label and a common definition of ESG and environmental funds, investors rely on self-disclosure by asset managers and classifications from some commercial data providers, and the level of disagreement between these classifications is still quite high. So the three main data providers agree in less than 20% of the cases, or all three of them, that a fund is ESG. So here, well-designed labels could materially reduce the risk of greenwashing. At the same time, looking on the right, environmental and other ESG funds do appear to have reduced the emission intensity of their portfolio by more than non-ESG funds over the last 4 years. But the extent to which this is driven by simply reshuffling portfolios towards already low carbon sectors or by firms actually decarbonizing themselves, that remains unclear, but I think it's an important element to consider when for the ultimate goal, of course. New instruments such as sustainability-linked bonds that link borrowing costs to specific company-level sustainability targets partly address investor concerns about greenwashing in the green bond market. And greenwashing also poses a risk to financial stability because it could lead to an undervaluation of transition risks and to potential fire sales of green bonds. A common regulatory standard that requires regular standardized reporting, impact assessment, and review by approved external reviewers, and this is proposed under the EU Green Bond Standard, that could provide assurance that green bonds effectively finance the transition and alleviate risks to financial stability. And implementing the standard and making it mandatory within a reasonable period of time could enhance investor confidence in this asset class, reinforce then the flows of funding to transition, and ultimately reduce risks to financial stability. Now, for financial markets to be able to price climate risk appropriately, it's important to enhance corporate climate disclosure, and in particular to strengthen and standardize the disclosure of absolute emissions reduction targets, and transition plans with concrete milestones that investors can actually monitor. And this would also help credit rating agencies to account for climate-related risks in their credit risk models. And this is crucial given the wider role that ratings play, of course, in the risk management of portfolios. So in this context, we support the development of consistent climate disclosures via the Corporate Sustainability Reporting Directive and IFRS Foundation, and also the convergence of these requirements in common minimum international standards. And in addition, regulatory standards on sustainable financial instruments, such as the EU Green Bond Standard and any labels, they are key to reducing the risk of greenwashing. And finally, strengthening capital market also beyond sustainable finance segments would help channel further investments toward. Now, let me briefly look at the role of the insurance sector. For obvious reasons, it's very exposed to climate risks. And we see on this chart also on the left that the economic costs of climate-related events are increasingly material in Europe, and especially so in lower income countries. But only 22% of losses are insured on average. And the ongoing climate change is expected to cause this protection gap to widen. Insurers play a crucial role, of course, in mitigating the macroeconomic effects once a catastrophe has happened, caused by climate change. An estimate suggests that uninsured losses have a negative aggregate impact on a country's GDP, while this is not the case if the event is insured. And specifically, the payouts from insurers reduce uncertainty, and they support aggregate demand and investment for reconstruction. This then helps to accelerate the recovery from a natural disaster. And as such, insurance also increases the resilience of the financial system as a whole to catastrophes. A widening insurance protection gap may pose financial stability risks and reduce credit provision in countries with large banking sector exposures to physical risk events, while a lack of insurance may prevent some property qualifying as eligible collateral in the current framework and trigger higher capital needs for existing lending. So closing the climate insurance protection gap is important. It would reduce the macroeconomic costs of catastrophes while incentivizing adaptation and risk reduction from policyholders. ECB and EIOPA are working together to assess the role of insurance in mitigating the macroeconomic costs of catastrophes and to design effective policies to reduce the climate insurance protection gap. Here, it's important to foster the development of private insurance or reinsurance, since this should be the first and primary line of defense against natural disaster losses. But since catastrophes are not perfectly insurable and the risks are expected to grow, policymakers need to consider putting in place some public-private partnership to enhance the risk assessment, the risk transfer, and risk prevention, of course. So let me turn more specifically to the involvement of central banks, in particular the ECB, in the regulatory debate. So first, I'd like to mention that at the ECB, we have already conducted climate stress tests, both at the macroeconomic level as well as looking at bank-specific resilience. We considered several transmission channels for climate risk. We estimated credit and market risk and what it implies for banks' default probability. And this is very useful input for designing appropriate policies, and I will go more into detail in a minute. I hope that the preceding evidence has convinced you that the unprecedented and global nature of climate change calls for a deep understanding of its implications on the financial system and for broader coordinated policy responses across different financial sectors and jurisdictions. Now, macroprudential policies that are focused on systemic aspects of climate risks would play an important role in addressing the challenges for the financial system. And this would complement supervisory efforts and macroprudential regulation that is focused on reducing credit risks. Combined together, micro and macroprudential tools could ensure a holistic treatment of climate risks that could cover all the dimensions as we understand them. And you see in this diagram some of the discussed elements of possible micro and macroprudential frameworks. They are areas that clearly belong to either one or the other, but they are also measures that serve both purposes, such as the common minimum requirements or disclosures. Looking at the macroprudential side, climate risks has been a key risk and supervisory priority already since 2019, and not only as a longer-term risk, but also as a short-term medium risk. And earlier this year, the ECB banking supervision had planned a number of supervisory activities to further review these risks and check progress of banks in meeting the ECB expectations. And what the ECB has done was a thematic review, a climate stress test, and a targeted review of exposures to transition risks of banks' commercial real estate exposure, and also several on-site missions. The preliminary results of the thematic review that will be published shortly show that most banks have started to adapt their practices to incorporate climate and environmental risks into their daily business. But clear gaps remain in all areas of focus contained in the ECB's guide on these risks, and individual banks are not making progress across the board. Still, there are some good practices that are observed in some institutions, and they confirm that what the ECB is asking of banks can actually be done. The results from the climate stress test revealed that despite the relevance of climate-related risks, most banks do not yet have robust climate stress testing frameworks, and they also lack relevant data. As a follow-up, the supervision will continue monitoring the bank's progress on climate risk stress testing and identify good practices that could be used to guide institutions that are currently at a less advanced stage. The targeted review focused on commercial real estate exposures. Here the ECB asked banks to provide the energy performance certificate data on commercial real estate exposures to understand how exposed banks could be to transition risks. But this study at this moment in time, it suffered from both from data gaps and also robustness. Now, yeah, the climate risk is a key priority for macroprudential policy, and the colleagues in banking supervision are also looking at all kinds of different aspects that I don't want to go into a lot of detail here right now. Let me just mention, because it's an EBA workshop today, just want to point out that we have also actively contributed to the EBA's Pillar 3 ESG ITS and support their future update and expansion. Macroprudential policy. So there are several macroprudential policy options for the banking sector one could consider when exploring how systemic aspects of climate risk could be addressed. Taking a macro as opposed to a microprudential approach can be justified by some of the evidence that I've shown you earlier, in particular the default correlations, as well as the fact that exposures stretch across the entire financial system and are also not limited to banks only. Let me mention two tools that we think have a relatively strong rationale and could be particularly useful to target climate risk. The systemic risk buffer. This is already part of the existing European macroprudential toolkit. It aims to address systemic risks that are not covered by the capital requirements regulation or by the countercyclical capital buffer and other buffers. Therefore, it could be used as a general tool to guard against systemic aspects of climate risks. This buffer would also allow for sectoral application and could therefore be used to contain the buildup of risk concentration in climate risk relevant sectors or regions, like those that are particularly exposed to physical or transition risk. It could also enhance the resilience of banks by ensuring additional capital. And some adaptations of the existing rules may be needed to make the buffer suitable for climate risk, but we think that these changes could be limited when compared to other options. So to understand better which type of adjustments may be necessary, one could analyze what scenarios could require use of such tool and how the buffer could be calibrated. Another interesting tool are concentration thresholds that could incentivize banks to properly manage or reduce their vulnerable exposures above a certain level. Here, vulnerable exposures to carbon-intense sectors or exposures to regions that are particularly exposed to physical risk, for example, to those regions that are prone to flooding or to heat waves. And such thresholds could be calibrated in various ways. For instance, as a percentage of Tier 1 or CET1 capital, and they could be designed so that their breach triggers supervisory scrutiny or requires banks to explain how they would address concentration risks. And there could be one or more thresholds to address the various dimensions of climate risks. Yeah, so we think they could present a relatively flexible and efficient near-term solution. So I say we could look at this. So you see that the whole thinking around the macroprudential treatment of climate risk is still really at a very early stage. So yeah, also both internally and at the international level, this is all still being discussed. Now, in the last part of my talk today, let me focus on technological innovation, the risks and opportunities from technological innovation and the needed policy response. So compared to the previous topic, work is still in its infancy, but I fully agree with Jose Manuel, it's an important topic. The past years have demonstrated how rapidly the world around us can change and also influence the financial sector. And it's challenging for all of us to adapt to such changes, but there are also opportunity to innovate in order to cope with these changes. And let me first focus on the opportunities, explaining how not only fintech startups, but also banks can benefit from innovation. And areas where this can happen are, for instance, artificial intelligence and automation, secondly, cloud computing, and then third, in the area of digital assets, where banks could maybe catch up to the more crypto natives in a more mature and formally regulated markets. And let me leave out the climate transition for here. Now let's go one by one. So on the artificial intelligence, advances in computing power, data volume, and connectivity are core components of the industrialization of artificial intelligence. And together, this led to an expansion in applications over the past years, from which also banks are benefiting in various respects. You see on the left-hand side that outside the tech sector, financial services, one of the leading early adopters of artificial intelligence. And according to McKinsey, there's a large potential in banking for business applications and economic value for a range of analytics and artificial intelligence. You see on the right results of a survey by them where in which areas banks plan to employ artificial intelligence. And mainly, I think banks seek to analyze structured, unstructured data, turning raw data into more actionable intelligence to improve revenues, as well as to reduce losses and costs. When it comes to cloud computing, according to this chart, banks seem to be at the forefront of using this new technology, but it also appears that they have a lot of catching up to do. Banks invested in the first mainframe computers as far back as the 1950s, 60s, and over 50 years, and a myriad of computing innovations, the majority of the incumbent banks still use these legacy systems that are mainframe based and often running outdated languages. So there's really some catching up to do. And let me stress that IT expenses as a percentage of revenues are notably higher in the banking industry than any other. And estimates by Citigroup indicate that approximately 15 to 25% of banks' annual costs are actually allocated to IT. So there's large benefits to be gained here. Now, of course, moving core banking services onto the cloud is a strategic management decision, and it also comes with benefits, costs, and risks. Banks benefits mostly from the ability to obtain computing power and tools at a lower cost with improved functionality. But of course, there are costs and potential risks as highlighted by the operational risk incidents like fires and data centers, terrorist attacks on infrastructures, for instance, that are also, that are of course present. And then finally, technological innovation in the form of distributed ledger technology may affect financial institutions and financial markets by transforming financial products, market processes, market infrastructure, and also the market itself, and beyond what we currently observe for crypto assets. And it seems that one of the main benefits of this DLT technology is that it could significantly lower costs and increase efficiencies for financial institutions. And together with, for instance, the use of tokenized assets, that could allow for cheaper, faster, and more customized financial intermediation. But the use of this comes with risks, and operational resilience must be ensured. And the number of recent, and the size of recent hacks, exploits on different blockchains that are shown here on the left-hand chart, they exemplify the risk of this technology. And of course, some risks are also related to the crypto asset world in particular. And as shown here on the right, this crypto asset universe has increased dramatically over the past years in size and also in complexity, but it also shows quite some volatility. And importantly, as you will recall, the May-June crypto turmoil that came after the Terra Luna failure that highlighted the risks of this whole ecosystem, and there has been widespread contagion within the crypto asset ecosystem. Yeah. So most DLT use cases by banks are still in the experimental or development stage, and linkages between crypto assets and the euro area banking sector have been limited, but banks seem to be showing growing interest. So we'll see where this leads to. Now, let me come to possible policy responses. To design the right policy response regarding digital assets, it needs to balance potential benefits and risks. So in a nutshell, policy should meet the goal of facilitating access to innovative financial products, but it should ensure consumer protection and also notably financial stability. And this is what we show a bit on the slides. And if you want to realize the benefits of digital innovation that I've mentioned earlier, it's important also to have a well-functioning financial system that can adequately and effectively contain the associated risks and also meet other policy objectives. So let me focus here briefly on the regulatory initiatives related to the crypto assets ecosystem. Given the speed of developments and the increasing risks, it's important to bring crypto assets into the regulatory perimeter and under supervision, and I would say as a matter of urgency. Here we have seen important developments recently, both at the international and European levels. In October this year, the FSB published a proposed framework for the international regulation of crypto asset activities. And this includes recommendations for regulation and supervision of crypto asset activities and markets, as well as global stablecoin arrangements, with the aim to promote consistent and comprehensive regulatory approaches and to strengthen international cooperation, coordination, and information sharing. And at EU level, the EU regulation of markets in crypto assets, the MiCA regulation, has now been agreed by co-legislators to make it marks a significant milestone. Yeah, it's also important to review the sectoral regulations to ensure that any financial stability risks posed by crypto assets, particularly those arising from their interconnectedness with traditional financial institutions, are mitigated. And here the Basel Committee plays an important role and has consulted a prudential treatment of banks' exposure to crypto assets. Now, as my very last point, let me just mention cyber, even though I must say I don't know so much about cyber, but I think it's very clear that cyber risks comes with digitalization. It increases the potential for future cyber attacks increases as more users and data and devices will increase the number of potential routes for attacks. And the threats have indeed become significantly more frequent and severe over the past decade, particularly during the COVID-19 pandemic. And we will see to what extent this has been only a temporary factor or whether to what extent it will gain more importance going forward. I suspect the latter. And also, as you see on the right-hand side, for instance, for the case around the US elections, electoral cycles seem to also play a role where there are more cyber attacks during those episodes. So in terms of number of attacks at the sector level, it's mostly public administration, healthcare, and education, but still attacks on the financial sector account for around 5 to 10%, as you see on the left-hand chart, and mostly it's criminal actors that are behind these cases, and it's mainly financial motives that are behind these attacks on the financial sector, even though they also protests play some role here, as you see on the right. Now, the marked increase in global cyber incidents begs the question whether and to what extent risks stemming from such events are idiosyncratic or whether they have the potential to pose a systemic threat to financial stability, and also whether existing frameworks on the sources of risks and vulnerabilities to financial stability adequately capture relevant implications of cyber risks. Cyber risks can become systemic if a critical entity is affected, or if interlinkages between multiple affected non-critical entities cascade into systemic threats. The increased digital reliance of virtually every aspect of our financial lives creates a necessary condition for cyber risks to become systemic. And within the financial system, operational, financial, and confidence channels can amplify and propagate the impact of cyber incidents up to the point where they impair the provision of key economic functions. So I would say there is a risk to financial stability. Now, there's a lot of work going on in various international fora and also by the European Systemic Cyber Group. Let me now skip this in the interest of time. And also this slide here, I mean, one example is the work done by the Eurosystem for Financial Market Infrastructures via long-term strategy, but let me not go into detail here. And it brings me to the end of my presentation. So I have covered a number of threats and opportunities for the banking sector related to some more profound global changes, such as the current macroeconomic environment, climate change, and technological innovation. And I hope that I could convince you that the public sector or central banks invest a lot to try to understand what this means for the banking sector and financial stability as a whole, and how we are trying to design policies to safeguard financial stability and to scrutinize financial sector participants to make them internalize such risks. Now, again, the title talks about macroprudential policy. I have not talked much about macroprudential policies because we are not there yet. We are still at the beginning, I think, to try how to cope with these changes that are related to innovation and climate finance. And you also, I think, saw that it's currently a very challenging environment for banks because of all the macroeconomic environment that I outlined at the very beginning. So I would hope that the public and private sector nevertheless keep some momentum here. Yeah, let me stop here. Thanks again, Jose Manuel, for the invitation, and to everyone for organizing the workshop. Thanks very much.
So thank you very much, Cornelia, of the impressive presentation that did highlight important issues and challenges in all the areas we're covering. So current developments, climate finance, and technological change. So let me now open the floor for any questions, either from the audience or from the virtual participation here. Who wants to be first? On the chat, for the moment, we have no questions. Okay, so maybe just in waiting for potential questions coming from the floor, so let me just make one point. I think there were interesting observations in the slides, a number of them, obviously. One that I found quite striking was the analysis of the default correlations in terms of the transition risk, which is, of course, something that will have quite profound implications potentially for the financial markets and certain types of products in financial markets in particular, which rely on estimates of default correlations such as structured products, securitization instruments, and so. So how do you see this default correlation playing out in terms of kind of broader financial market risks going forward?
Yeah, thank you, Olli. I mean, I think it's a very general question, no? So, I mean, I think it's very clear that if there are certain parts of the financial sector, or let it be the banking sector or the non-bank sector, if they have similar investment strategies, and in particular, if you look at the regional level now, so regional banks, I mean, we saw that, for instance, the risk of physical hazards is very large in some, for instance, in Greece, I think it was the highest number because they're so exposed to both floods and wildfires, let's say, that banks in those regions, I think it's very clear that there's a correlation there. So if you assume that you really have a devastating flood like you have had in Pakistan, then the entire sector can be vulnerable and at the same time. So I think this is really, for me, the clearest reason why we should not only look at macroprudential policy measures, but also take the systemic perspective and look at a macroprudential framework. And with, I think, physical risks, so in the end, a lot of, so the network for greening the financial system, doing a lot of estimates how physical risks exposure will increase over time if mitigating policies are, in particular, if they are not adapted. And you see that I mean, it's a highly nonlinear, no, but the probability of having such large physical risk events is then clearly increasing over time. So it is something that I think has a really a time dimension to it.
Okay, thank you very much. I was also highly impressed to see one of the slides where you show the IT expenditure by sector, where banks are actually by far the highest spenders in IT, even substantially more than high-tech sector. So I think this just probably tells us that the challenges are quite immense, and competition both within and outside of the sector is quite immense, forcing banks to move forward. This is not like a question; it's more like just an observation of the slide. Unless we have any further remarks from the floor, we have one question here. Please wait for 1 second. You will receive the microphone.
Thank you for a very interesting presentation. So I have a technical question. For the stress testing, so you have climate variables, and you also imagine you have economic variables. And when you do stress testing, you stress one of the two. So I was wondering, for this exercise, how it was implemented. So it was stressing one of the two groups together. It was taking into account also the dependencies between these two parts. I'm not sure if my question is clear. Yeah, thanks.
I think your question is clear, and to my understanding, we try to really also look at the interdependency. So we look at both of these aspects because I think they are both relevant, and reinforce each other probably.
Thank you very